still off doing his flying. So if you look up in the skies around Victoria, you might spot him paragliding by over the next couple of days. So good luck to him with the competition he's in. Very interesting week for markets. We have had obviously a lot go on since I spoke last week. Obviously, the conflict in Iran escalated very quickly last Saturday. And that's caused a lot of issues with energy markets and just global markets in general. So looking at our market over the week, we were very strange. We basically finished flat on Monday, even though we were sort of one of the first major markets to open once the conflict had started. And then over the rest of the week, we've fallen away fairly solidly. We're down about 250, 300 points. A little bit of a rally yesterday, but certainly likely to see a fairly solid down day today, with the Dow down around 800 points last night. So expects a fairly big day of selling. A couple of big things this week. We had dividends for our major resource companies, BHP, Rio, Woodside, were all ex-dividend. QBE in the insurance space also ex-div. Strangely, the moves yesterday when both BHP and Rio were ex-div were interesting because both them didn't fall by their full amount of their dividend. BHP sort of covered about half its dividend, only down about 65, 70 cents. And Rio actually finished up for the day after going ex about a $3.50 dividend. So unusual. We do see these things happen from time to time, but quite unusual to see certainly a stock like Rio recover so much of the dividend intraday. I expect today will be a very different story with such a big fall in the US. Our SPY down about 125 points this morning, definitely suggesting a solid fall here. And looking at the closes out of the US for our big resource companies, expect sort of multiple dollar falls for certainly Rio, probably about a $1.50, $2 fall in BHP looks quite possible. Looking at some ideas around this week, we're still running the theme of writing covered calls over the banks for anyone holding bank shares. The premiums that are available are still very attractive, especially if you start looking out to April. There's some solid premiums at levels that would be very, very attractive if you did get called away on your stock. So we still think that's a good trade. I'm very cautious with selling calls over the banks, but I think there's still a good trade opportunity there at present. A couple of other stocks that we've sort of talked about over recent weeks. Woolworths, they also went ex-div this week. I think they're still looking pretty expensive, so selling covered calls there would be a great strategy. If you're long the stock, I would probably be happy to lighten a little bit and maybe move into Coles, which we've talked about, or even just move into a bit of cash. The yield on Woolworths is generally pretty low, so with the stock at these levels, happy to take some money off the table there. James Hardie, which is a stock we've talked about quite a lot in the past, it's fallen back pretty heavily after its results. A lot of that will be concerns regarding the US economy. So with the stock around $31.50, I think there's opportunities in it. So be one I'll be watching. Probably wouldn't jump into anything yet, but I think if it starts to stabilise, I think it's a buy at the right sort of level. And a lot of that will depend on matters in the US, whether the Trump administration look to do anything on their housing sector, which is definitely struggling in the US. So any sort of news regarding stimulus or some housing policies would probably see James Hardie get a decent lift. Probably the major topic we should probably cover at the moment is obviously the oil price. The big thing yesterday, we've had oil jump up again as concerns about the supply of oil coming through the Strait of Hormuz, which is certainly a concern with Iran threatening to blow up ships and the like. That's pushed oil over $80 a barrel. And when oil goes over $80 a barrel, we start to look at what the flow-on effects are going to be. The standard sort of things are we see a slowing in the global economy. So recoveries that we have been seeing would certainly be stalled by oil at these levels. It also weakens demand for general commodities, so hard commodities start to slow as demand just generally backs off. Inflation is something that really does start to spike with lifts in oil because there's a flow-on effect of costs to the oil market, from the oil market to pretty much every product. And that will be something that I think certainly the Trump administration won't like. Any upside pressure on inflation is going to make it much harder for his desire to see rates lower. I know he's appointed a new Fed chair, or his desired new Fed chair, and on the basis that that gentleman will be more hawkish on rates and will certainly start to reduce in line with what Trump's sort of hoping. I think that gets harder if inflation does start to blow out. I thought I'd just cover some general things on oil and the Australian situation. We have equivalent of 36 days of oil supply in this country, well below the recommended 90 days the International Energy Agency suggests. So we are in a little bit of a trouble position with the conflict going on. For our oil, we get basically 90% of it imported from Asia for our refined petrol and diesel. The concerns we've got right at the moment is China, who is one of the major suppliers into the Asian market, which is Singapore, South Korea, and Malaysia, is where our refined fuels are coming from. China is one of the major suppliers to that region, and China is certainly talking about reducing export volumes right now. China it gets most of its oil through the Middle East. So the flow-on effect will be that Singapore, probably our major trading partner in the oil game, has about a month's worth of oil available. How quickly they start to tighten that supply, because their supply from China is going to start to dwindle fairly quickly. So that is a real concern, and something we as a region need to be sort of ready for some oil shocks, potentially some price shocks at the pump. I did touch on resource stocks earlier about them going ex-dividend. Look, they're still at very elevated levels. So I think for clients that do own BHP or Rio, writing covered calls right now would be a very, very sensible strategy. BHP is still trading sort of above $50. It'll be about $53 a share today. I think you could write calls out to April and pick up some really nice premium. Anyone losing BHP shares at sort of $55 is going to be in a pretty strong position. I think we'll all have some solid gains if we did lose our stock at that level. So I think that's a really good strategy. Rio, which not as many clients own, but I think if you can sell calls around that 165, 166 level, again, I think that'd be a strong position, and you'd be netting out a pretty good profit if you do lose a stock there. Alternatively, if you don't own either of those stocks, there is potential to look at buying some puts for some downside, because both stocks really probably have 5 or 10% of sort of hot air in them that could come out as commodity prices start to back off a little bit. As I mentioned, we've got a pretty weak SPI today, so expecting a fairly solid sell-off. The index probably getting down towards the low 8,800 level. And I think that'd be where I would certainly be starting to look at some buying opportunities. Looking at some of our sort of market-focused ETFs, VHY is one of the ones we tend to buy whenever there's a decent sell-off. So I think that'd be one if you were looking for a stock to buy. If you can pick that up on a decent down move today, I think long-term that's a great one to hold. So that's certainly where we'll be focusing. Thanks for your time. Bye. There you go.